Good morning, ladies and gentlemen. Thank you for joining us in this early morning session on Middle East security and global markets. My name is Ziad Daoud. I'm the Chief Emerging Markets Economist at Bloomberg. And I'm delighted I'll be spending the next hour with you in various forms. I'm going to be giving a presentation, which is the most boring part of the next hour. I'll be talking about 5 questions, claims, themes that are related to the region, and then we're going to have conversations after that. So I'll start by talking about 5 claims, and these 5 claims have the following sort of features. First, they are somewhere in the intersection between geopolitics and economics, which is what this session is about. And second, they're about the interaction of the Middle East with the world. So how the Middle East impacts the world and how the world impacts the Middle East. So what are the claims? The first claim I'm going to make is that there is rising geopolitical risks, there's rising geopolitical competitions in the world. There's rising US-China competition in the world. But the Middle East is unlikely to take sides. And let me explain this in a bit more detail. So the fact that there is rising US-China competition is fairly clear. We see it in the trade war. We see it in the technology war over chips. We even see it in growing global alliances. We saw, for example, there was an expansion of the BRIC alliance, which is led, you could say, by China in 2023, effective 2024. And we saw the Middle East was part of that. It was part of that because 4 countries in the Middle East were invited to join BRICS: Egypt, Iran, the UAE, and Saudi. All of them have accepted the invitation to join an expanded BRICS, except Saudi Arabia, which has neither accepted or rejected the invitation. So you have this rising competition in the world, but the region is unlikely to decide to take one side or the other. And it's unlikely to decide because the region, in particular the Gulf, has deep security ties with the US. The US is the #1 security partner with the Gulf. It has been for a number of decades. There is an unofficial sort of pact between the Gulf and the US, an energy for security pact, where the Gulf secures energy movement and flows to the world in the form of oil and gas, and the US ensures the security of the Gulf. And yes, this pact has gone through some hiccups and fractures in recent times, but it's still fairly intact. So the Gulf has deep security ties with the US. The US is still the #1 security partner to the region, and we saw it with President Trump's visit last week to the region. But the Gulf also has deep economic ties with China, and we see it in the trade data. So if you look at, for example, what I have here is basically the Gulf trade with China versus the US, and you can see that trade with China has grown significantly in recent years. It has outgrown the region's trade with the US, and it now stands at 4 times larger than the trade with the US. So in a world where you have increasing competition between the US and China, the region is unlikely to take sides because the US is the #1 security partner and China is the #1 trade partner. So that's the first claim I want to make. The second claim I want to make is rather obvious, which is basically there is a raging trade war in the world today, and that trade war is weighing in on the global economy. And how do you see this trade war? You see it in 2 things. You see it in the left chart, which shows you the effective tariff rate imposed by the US, and that has gone up significantly. Before President Trump took office, that was somewhere around 2%. That's the average tariff, effective tariff that the US charges imports into the country. Now it has gone up to above 10%. It goes up and down depending on the deals and the poses and all that stuff. So you have more barriers and more tariffs, and that with less trade, you do have slower economic growth globally. But you also have something else, which is basically have rising uncertainty. We don't know where that number is going to settle. We have tariffs that go up and then go down. We have tariffs that get imposed and then get exposed. We have negotiations over all of these. And therefore, you see the right-hand side chart, which is our Bloomberg economics indicator of trade policy uncertainty, has gone up significantly as well. And that has an impact. If you're an investor and you want to decide whether to build a factory in Mexico or to build a factory in the US, the tariff rate is an important determinant. If you think tariffs are going to be high between Mexico and the US, then you probably set up your factory in the US. If you think they're going to end up settling at a relatively low rate, then you build your factory in Mexico. The fact that you don't know whether they're going to be one way or the other gives you uncertainty. And what you do with uncertainty, you pause and you do nothing until you get more clarity. And the pause in investments means slower growth. And you see these slower growth numbers everywhere. We have a team that forecasts the global economic growth. We have revised down our growth for this year. The IMF has the same thing. They have revised down the growth for this year. At Bloomberg, we track what all forecasters are doing in terms of estimating global growth. And the consensus forecast has gone down this year. So you have a trade war that's increasing barriers, but also increasing uncertainty, and that is weighing down on global growth. So that's the second claim. How does this impact the region? The main channel is oil prices. That is the number one channel through which what's happening in the world impacts the region. And what is happening to oil prices is my third claim. Oil prices are getting a double whammy. They're getting the slower demand. I've just told you that everyone's revising down their forecast for global growth. Less global growth means you consume less of everything, and you consume less of everything, you consume less energy and less oil. And therefore, demand for oil is coming down. And again, if you look at the major forecasters for oil demand, whether it's the Paris-based IEA, whether it's the US-based EIA, and whether even OPEC itself, all these entities are revising down the demand growth for this year for oil. And that has taken a toll on oil prices. But that's not the only thing happening to oil, because supply is also increasing. So the main model in economics that works everywhere is demand and supply. When you have falling demand and when you have a lot of supply, prices are bound to come down. And where is supply coming from? We have supply from everywhere in the world, but there's been a change that's driven by this region. And that is OPEC Plus has changed policy. For 5 years, since 2020, OPEC Plus had a simple strategy, which is basically you restrict supply, you increase prices, and try and maximize revenue. That changed. And that changed in April when OPEC Plus surprised markets with a larger than expected output increase. It was confirmed this month in May when they did the same thing. And they tell us they might do the same thing going forward. And all markets are reacting. So OPEC Plus says we're doing this because we're trying to punish countries that are producing above their quotas, like Kazakhstan. If you think that's if you think that's a convincing argument, it's up to you. I'm not totally convinced by this, for the record. But whatever you think the motivation is, oil prices are reacting because of slower demand and because of excess supply, and they're reacting by falling from about $80 per barrel in January to around $65 today. Now, there is geopolitical stuff happening also. There's news overnight that there are reports that Israel might be preparing for a potential strike on Iranian nuclear facilities. That could or could not affect supply from the region, but markets have reacted overnight to this, and we'll probably discuss this in the upcoming conversations. So that's the third claim, that oil prices get double whammy as things stand from slower demand and from higher supply, including from OPEC+. The fourth thing that's happening in the world is the dollar and the US status. You see, the dollar is the world's most dominant currency for trade, for debt issuance, and for savings, for reserves. And the US is typically the world's #1 safe haven. When anything bad happens in the world, investors tend to flee to the US. And when they go to the US with all their funds, two things happen. US borrowing costs come down, US yields come down, and the dollar increases in value. That happens even when crises originate in the US, like the global financial crisis in 2008 and 9. So you see it in the right-hand side chart. Even then, investors flee to the safety of the US, yields go down, dollar goes up. That happened also in COVID, exactly the same dynamic. It didn't happen this time around. In April, something different happened. With higher uncertainty, with the fact that people were revising down the forecast for global growth, US yields, US borrowing costs were going up, and dollar was coming down. There's a question mark. Does that mean the US safe haven status has changed? Is it no longer a safe haven status? Is the dollar's dominant role as a currency, as a world dominant currency, has changed? It's a question mark. Some people say this is permanent, as the new world order is changing. Some people say it's temporary. And then there was something that happened at the end of last week where Moody's has downgraded the credit rating for the US. So people, and that dynamics continued. So US yields are up, the dollar is down because of concerns about the change in the global order, but also concerns about the debt and the deficit status of the US, which didn't start with this administration, but didn't end with it. So the role of the dollar is important, the role of the US as a safe haven is important, and it matters for the region. You are here in Qatar, and Qatar's currency is pegged to the US dollar, as other currencies in the region. The Gulf has large savings in the form of reserves. They're mostly in the form of dollars. So the dollar, again, plays an important role. More importantly, the main export that comes out of the region, oil and gas, is priced in dollar. So you can see the centrality of the dollar to the regional economies. And its role and its impact going forward is something to be discussed. And I think it's a question that is important for the world, but also for the region. The last thing I want to talk about, the last claim I want to talk about is originating from the region, which is basically, we often think of the region as a source of energy and as a source of capital to the world. And that's why a lot of people, for example, are here at this conference. It's a source of capital, investments, loans, grants, all sorts of things. And this is still valid. This is still valid as an energy source. Most of the region is still, not most of the region, but countries in the region are still an important source of capital. But that has changed in one place, which is the largest economy in the region, which is Saudi Arabia. So we often think of Saudi, as I said, as an important source of energy in the form of oil and an important source of capital. It's still a dominant and important energy player in the world. But it's no longer an exporter of capital. That changed last year. Last year, Saudi ran a current account deficit, which means that it became a net borrower from the world rather than a net lender to the world. That is a rare event that only happened in 2015, in 2016, and 2020 this century. And it's also unusual because it happened last year when oil prices averaged $80 per barrel. This is not a temporary shift. If you think it happened when oil is at 80, if oil is at 65, which is where it is now, you think that will continue to happen. And if you look at the IMF projections for what Saudi current account they expect it to be, which is the white bars here in this chart, the IMF expect the current account in Saudi Arabia to be in deficit out to 2030. Translation, the IMF expects Saudi Arabia to be a net borrower from the world, rather than net lender to the world in the coming 5 years. That's a different story. So Saudi is one story, but if you think about Kuwait, if you think about the UAE, if you think about Qatar, they're still a provider of capital to the world, but not Saudi Arabia. Which puts last week's event into perspective. You know, you have the US president who came to the region seeking deals. There were deals with Saudi. The White House said Saudi has committed $600 billion. The White House is chasing $1 trillion from Saudi Arabia. And if you think Saudi is no longer going to be an exporter of capital to the world, then it's very difficult to make these investments and purchases that the US is looking for. Unless Saudi, of course, borrows from the rest of the world and invests in the US. So let me summarize the 5 themes. So basically, or the 5 claims. A, I think in a world of rising US-China competition, the Middle East is not going to take sides. B, there is a raging trade war in the world today, and that's weighing in on the global economic growth. 3, the translation to the region is that oil prices are coming down, both because the global economy is slowing, but also there's a lot of supply, and that's partly because OPEC Plus is increasing its output. 4, there's a question mark about the role of the dollar and the US as a safe haven for the world, and that matters for the region. And 5, the region, or the Gulf, is still largely an exporter of capital, except in its largest economy, which is Saudi Arabia.